in the alpha engine, we sort of have the return piece, which we've talked about, which I think is critically important. But there's also the resilience piece. When you go to sort of engine number one, the beta engine, you can't access hedge fund sort of exposures. You can't access absolute return sort of exposures. And while there was a big push about 10, 15 years ago to try and sort of create very liquid hedge fund type exposures, we just don't think it works. We just think it's not the right construct for it. A lot of the world doesn't quite know how to fit hedge funds into this whole equation. We have a very clear view on where hedge funds fit in. We think the way you have to think about hedge funds, particularly what we call absolute return funds, is as an alternative safety net. Right now, when you think about sort of returns, we've talked about returns. In resilience, what do you do for a safety net? What do you do to create a resilient portfolio? Some people invest in government bonds. You sort of have gold, which does well when everything else does poorly. You have other sorts of assets which sort of seem quite stable. You'd argue some types of infrastructure assets provide that, certain types of core real estate provide that sort of exposure. In our view, absolute return should be part of that consideration set. Because if you look at the data, it does 300 to 500 basis points over cash, over cycles, which is extremely valuable when you think about it at times of crisis.
Well, so the absolute return hedge fund strategy as a sector outperforms that much in general.
So
as an average.
As an average. And it has very low volatility. If you construct it well, it's a very
What does that look like? I know nothing about hedge funds, and I suspect even though they're very sophisticated, a lot of my private equity viewers may know little. So what is that typically? How are they getting that outperformance? And what's the diversification and correlation? What instruments are they in, and what risk premium are they looking at?
So they are, the way absolute return hedge funds work is usually there is a group of strategies that are put together where they have very little correlation to the broad markets. They're trying to take the economic cycle and the broad markets out of the equation. And they're sort of saying, if we neutralize a lot of these other factors, can we pick up excess performance? In effect, what they're trying to do is they're trying to pick up pricing inefficiencies. They're trying to pick up returns from skill rather than returns from beta. And they're trying to package it, and they will use leverage. They will use a fair amount of leverage to amplify the inefficiencies. And so that's essentially how they work. And you have to put it together. Portfolio construction is critical. You have to diversify across different types of strategies. A lot of it is arbitrage. For example, they could be playing different sides of a fixed income curve because there's an inefficiency there. They could be playing different currency markets. They could be simply doing long short equity investing where they're sort of saying, I like this company more than that company, but I'm going to buy the company I like and I'm going to sell the company I don't like, but it's in the same sector. Therefore, I'm neutralizing the broad market exposure. I buy auto company X and I sell auto company Y, but I neutralize that, but I pick up the spread. It's a skill game, but you have to put it together very effectively. But if you do it well, and we've done it for long periods of time, you can pick up a good amount of outperformance over cash. So then if you're not worried about liquidity, you'd say, look, I'll put some money in cash for my safety net, but I'll put some in government bonds, which, by the way, you can access through engine number one because it's very liquid. But actually, I could put some in gold, which I again get from engine number one. It's liquid. But I could also put some in absolute return, and it just creates more resilience. Right?
Presumably, there's a huge dispersion of returns within those apps.
Huge dispersion. Not as much as venture capital. When you look at the dispersion of returns, it is huge, but the dispersion is a bit tighter than you look at it. So private equity and venture capital have even more dispersion of returns.
Really? Than the hedge funds?
Than the hedge funds. But the hedge funds, I suppose we look at a certain type of hedge fund, not a long-only equity fund, which has got a little bit of shorting, which sort of pretends to be a hedge fund. Right? So it's sort of, we have a very clear definition of what it is.
Yeah.